but there's this big piece of legacy with the death benefit.
Yep.
And knowing I have a death benefit means, hey, like I could actually stop utilizing banks in the future.
You know, if you factor in the cost of just other fees, now you're looking at an alternative account that needs to earn 6, 7, 8% every single year to keep up with the boring old life insurance. And that's just, Garrett, that's just one benefit.
I was watching Breaking Bad, and I thought that whole show happened because Walt didn't have life insurance.
Hey guys, it's Caleb Williams with BetterWealth.com. It is interesting to me.
First off, debt is a function of your
All right, guys, we're in Wealth Labs. I'm here with Garrett Gunderson, and we're going to talk about life insurance because that's what subscribers like to listen to or watch.
That's why I started. 1998. I was a field representative for Guardian Life. I actually sold variable whole life at first.
Variable whole life. I didn't even know that's a thing.
Dude. I mean, and then this guy from New York that was like, he was bald but had a ponytail, right?
Yeah.
So he just had the side hair and he came in and spoke in Salt Lake. And dude, I almost threw up, man, when he was like, let me show you the whole life numbers versus variable whole life coming out of the 90s.
Yep.
And they were so close. And he's like, that's the 90s.
Yep.
He's like, why would you ever put people at risk? And I was like, but you could convert it. And I converted all my clients to just regular whole life.
Yep. So what I want to do is you're very articulate when it comes to like why you do things, value creation. We just talked about your new book coming out called Money Unmasked later this year.
Are we allowed to talk about that on video? Because people shit all over me for mentioning the book on a video before. You know, like, you're just trying to sell your books. I'm like, yeah,
I can say it though.
It's making me so much money selling books on YouTube, dude.
Yeah, I love it. So all that to say, you have a lot of different mindsets around money. Life insurance, though, is something that is not super fun to talk about. Like, it's not a topic that people like will get you super popular. But we're in this niche on YouTube where there's people that understand infinite banking. Some people you call it cash flow banking. I call it the and asset. And it's like this concept of using life insurance not as not as like the end result, not as this is going to save your marriage, this is going to create cash flow, but as the foundation to say, hey, this is where we're going to store capital. This is where we're going to fund certain things. So how do you talk about life insurance, and where was your epiphany? I mean, you talked about the bald guy with the ponytail, which I, shout out to. I don't know if we're allowed to say his name, but
he was like a general agent out of New York for one of the Guardian agencies.
Right.
Ridiculously smart, scared the shit out of me.
Right. From there, what are some of the things that your like takeaways and like where you are now in 2023 with like where life insurance plays a role with someone's life?
Look, I started a policy when I was 19 years old because that's when I started in the financial business at 19. I had a $50 a month whole life policy. I wasn't overfunding it. It was just a base premium. Then I set up a second one shortly after, which was I bought an Acura, which because it was like the new Acuras were out and the old ones on the lot, they did this deal where you could lease it for $262 less of a payment than a purchase.
Wow.
So I leased it, put $262 a month in insurance, mostly overfunded. And then 39 months later, I used the cash value to buy out the lease. And now instead of having a 60-month loan, I had it all paid off in 39 months. And you could fully write off a lease. So I was like, this is a really cool situation. And then when everything happened in 2008, like I had a lot of real estate, but my whole life was instrumental to get me to the other side so I didn't ever have to declare bankruptcy, which so many of my friends declared bankruptcy.
Yeah.
They were over leveraged in real estate. Then the next time, there was chaos in 2020 or whatever.
Yeah.
It's like, I just don't lose any sleep. It's there. It's not failing me. I can tap into it.
Yeah.
I bought a business in 2014 with it. I bought real estate with it in the, I finished out a fourplex that went bankrupt in the development phase. And I just was able to pay cash for my cash value.
Yep.
I've paid off a higher interest rate American Express that I used to help launch my first book. I used it for, I don't know, so many things over the years. But I also had a long period of time where I never tapped into it because my business was going well.
Yep.
There wasn't any investments that were attractive, and I just didn't have to think about it. It was beating any savings account or money market or CD. It was losing out to maybe the stock market for a few of those years, which I didn't care because I care about my companies, not these companies that I know nothing about.
That's the thing.
Right. I always look at it as like my medium-term storage. And short to medium-term. Because I want to have at least 6 months of capital I could access outside of that policy. So some of that capital is just my checking accounts. It's cash in a safe. It's gold and silver. It's just basic stuff, and even I'll count like a small percentage of my crypto. Like I've got enough liquidity through that, and then I could always tap in after 6 months to my cash values. I could tap into it earlier, but there is one provision in the policies that say in certain catastrophic times that they could take 6 months to get you your money. So I'm like, cool. I just, safe kind of philosophy there. But what I really like is not only do I have some tax advantages, I also have these benefits like accelerated benefit riders on death benefit. So I don't buy long-term care. I'm just could use my death benefit. If I become disabled, they'll make the premium payments for me through waiver of premium. I like those factors because it's extra benefits. It's FIFO. I can take my cash out that I put in first before having to take out my interest. So there's a tax advantage. I could borrow against the cash value at preferred rates with the insurance companies, pay that back on my own terms, doesn't impact my credit. I like all of that, but there's this big piece of legacy with the death benefit. And knowing I have a death benefit means, hey, like I could actually stop utilizing banks in the future for my family because we could just have our own bank from the death benefits that come in and within a trust and within our cash values that we could finance everything. So whatever's happening in interest rates, we're like, inflation's high, let's just gouge everybody with interest. It's like, cool, well, I could just take withdrawals from a policy if I want. Because that's one argument people will give on YouTube sometimes is like, why would you borrow from yourself, you idiot? I'm like, well, first off, my money's still in the account earning interest or dividends. And it's just collateral that I then get and pay a similar interest. That's not borrowing. It's using collateral. It's just, you do it with brokerage accounts too. Second, I can take the money out.
If you wanted.
I can just withdraw. The reason I don't
is
because I want to continue to be able to put that money back in and using it over and over again, and I don't want to lose the benefit of the tax container that's there for me.
That's you just beat me to it. One of the number one things we'll get on YouTube is like, why would you borrow to use your own money? And just if we break down language, you're not borrowing your money. Your money's in your policy. You're borrowing against it. So that's one element. And then number two is you don't have to borrow if you don't want to. But number three is it's not just the arbitrage, because they're really, if we're being honest, you're not getting arbitrage with what you're internally making versus the cost of borrowing. But if you look at give them
more detail on arbitrage there.
So what I mean by that is, let's say the internal rate of return, the actual growth rate of what you're making
after expenses.
Like after commissions and all that stuff, it could be like a 3.5% to 4% internal rate of return. Meaning each and every year your cash value is growing at a 4% rate of return. It might cost you 5%. So a common question would be, why would I borrow at 5 when my policy's only earning 4, which is valid? Let's unpack this, and I actually would love to unpack this with you. Number one is that's a 4%, but it's not an apples to apples comparison to other accounts. So it's a tax-free 4%. Number two is there's so many other benefits to life insurance. The death benefit.
Right now, let's give an example of capital depreciation being protected, because we earlier today went through these articles where they're saying don't invest in bonds because interest rates could rise and lower the value of the bond. You don't have that risk in insurance. Once the dividend's paid, it's guaranteed. So if bond rates, devalue because interest rates increase, you still have your full amount available, and that decrease in bond value doesn't decrease your cash value, even though it operates in a similar way of fixed income.
Well, and I'm looking at just like, let's just say 4% is what you earn in your policy. If you factor in taxes, if you factor in the cost of buying term insurance, because
that's another one.
If you factor in the cost of just other fees, now you're looking at an alternative account that needs to earn 6, 7, 8% every single year to keep up with the boring old life insurance. And that's just, Garrett, that's just one benefit. Where I had the epiphany was like, oh, life insurance, you talked about chronic illness riders, the death benefit gives you other options in the future. We reacted and read this like crazy articles on retirement planning. Life insurance in the future, if you want to do the traditional retirement plan, will give you more options. and potentially higher cash flow. The point I'm making is it gives you multi-dimensional aspects. It gives your dollars more than one job. And for me, that's why I would borrow against it. It's worth more to my portfolio than 5%.
And let's think, like, this is the insane narrative. Hey, Caleb, you should buy term and invest the difference. Okay. And then if you're really good at investing or growing a business and 20, 30, 40, 50 years down the road, you've earned enough wealth, created enough wealth, you don't have a state tax problem.
Yeah.
So now you're 60, 70, 75 years old, and now what was your attorney going to tell you to do? Go buy life insurance to handle the taxes at a time where your health might not be as good. The premium's going to be much higher.
Yep.
And so when I already have a death benefit in those future years when they're like, oh, you're going to need this, I'm like, I already have it. Don't have to go pay extra money for it. Or there's a lot of really cool strategies around like charitable giving. It could be very efficient from a tax perspective, benefit the charity, cut out the government, and the government has approved all of that. If you have a death benefit, it means that you could give your money away to the charity, spend more because of the charitable trust allows you to take money during your lifetime. And when you die, the death benefit goes to your heirs or your bank so that your family's not born back into bondage. But what about these people that say, well, I don't want to leave any money to any of my heirs because I don't want to spoil them? I get that. So you want them to go back into a system that's rigged against them, like banking, like Wall Street, because you don't want to spoil them. Well, you're going to then, why not just teach them? Why not educate them along the way?
Yeah, I think that's super well said.
So I get, like, Wall Street had this narrative, which was like, insurance is stupid. It's boring.
Yeah.
Why would you want to do that? You want to do this cool stuff over here.
Yeah.
And that Wall Street's also the one that when the movie came out, Wall Street, that was about fraud, 400% increase in broker applications the next year. Like it was the private planes and the strippers and hookers and coke. And it's like, it's this, yet we think of it being that dirty and yet people still trust their money there.
Yeah.
Like I like that this is predictable,
right?
That it's viewed as boring to a certain degree because it doesn't need to be my most exciting asset. It just needs to be that foundational piece that you mentioned that I can count on, that isn't going to drag me into scarcity, that when the market's down and when the opportunities are there, I have capital capitalized where everybody else is going, well, I don't want to liquidate now because it's a guaranteed loss. And that, we're in 2023 as we record this, we're going to see so much turmoil that people with cash are going to be able to capitalize on.
Yep.
People with cash that aren't sitting there going like, oh, it's so hard to get a loan and it's so expensive. It's like, no, if you can just get that money quickly, there's going to be real estate deals that are unprecedented. There's going to be business deals that are amazing, but only for people that have cash to help bail people out that are overextended. So you can actually serve someone so they don't just go bankrupt and they end up with something versus just handing it over to a bank. I mean, so I like the nature of having access to the money. And I just don't like being in IRAs and 401ks where it's all government qualified and it's all restricted till 59 and a half and it's deferral, not tax free.
One of the biggest comments that we get is life insurance is a terrible investment. And so what's your response when people compare life insurance to the market, to real estate, to your business, and they say these other assets get you a better rate of return than the 3.5%, 4.5%, 5% rate of return that life insurance would give you?
I mean, there's a lot to say there, but at least look at this as an asset allocation decision if you're an asset allocation person that's comparing investments. If you believe that you should have any level of money in bonds or a fixed income portfolio, why not have a fixed income portfolio that comes with a lot of benefits, like a death benefit and tax advantages and no capital appreciation like we just mentioned. So even if you're saying that you're going to go invest and you're such a good savvy investor in these other areas, are you going to always be invested or are you going to be smart enough to be on the sidelines when things aren't good? Where are you going to store that cash? So why not use this as a place that you funnel money in and out with those benefits from a tax perspective, a death benefit perspective, that permanent death benefit instead of having a term insurance that goes away? Because if you buy term insurance, only 1.1% of that ever pays out. That's the plan, is that they phase you out as you get older. by making it too expensive. And if you lose it when you're older, because
Yeah.
now you're like, I can't afford this anymore. I just had term and my assets are big enough. Your assets become your insurance,
Yeah.
which means you're not going to have as much access to spend that money.
Yeah.
You're going to be living off just the interest. What if interest rates go down?
Yeah.
What if inflation's high like it is now? What if taxes go up, which could easily do? You're now subject to 3 factors you have minimal control over because you decided not to have insurance and your assets became your insurance because you don't know when you're going to die and maybe you don't want to disinherit your spouse.
Yep.
And that's problematic because you've now locked your money away.
Yep. What would the Rockefellers? It's a book that you wrote. It's taken off. Everyone that I know that is like in the insurance space or has any pulse of these strategies have read your book. Why did you write it? How did you come up with the name? And what was the epiphany to say, like, there's a book here?
I don't know if I've ever told anyone why I wrote it. I mean, a few people know. But I had this, so I had a firm, Wealth Factory. We built this thing called the Accredited Network. In the Accredited Network, we had all different types of financial professionals, accountants, attorneys, investment advisors, insurance professionals. And we had a lot of different life insurance professionals over the years. Some just because they couldn't handle the volume or they wouldn't design the policies based upon what's higher cash, lower compensation, or we just had people that were insurance people that thought that they could override and talk over the accountant or the attorney, and it created some conflict. So one of the guys that ended up being in the network was an old business partner of mine from one of my very, very first financial firm, Ingenuity, and his name Michael Isom. And so he was part of that network, but a couple other guys at Wealth Factory said, we want to create an insurance agency, left Wealth Factory, and Wealth Factory's like, well, they're right here down the street, easy to work with. And so Mike was no longer really doing a lot with our clients. And I thought, well, I'd like to do something with him. So we were hanging out in Vegas before, like in between Christmas and New Year's one year and just talking. And I was like, what if we wrote a book specifically addressing kind of the things around life insurance? Mike and I are in Vegas just hanging out. We'd travel together quite a bit and friends, even though this kind of thing with Wealth Factory wasn't working out anymore. And so I was like, well, I have an idea. What if we wrote a book? And then you went and spoke. And then you could use the book as a way to educate from, after you speak on stage, because I'd done that with Killing Sacred Cows. And so I just wrote this book to give kind of that education process around the cycle of insurance. That was the initial idea. So I was writing it. We were working with this guy, Michael Levin, who's a ghost writer. And as we were writing it, I was like, I'm just not inspired by writing this book. And I was giving it some thought, and I didn't really know what the title was going to be. And we were making like tremendous progress. Both the Michaels were great, but and one day this whole notion of like, I look like Jesus and what would Jesus do? People joke with me about that because of the look, and especially back then when I had less gray hair. And I was like, what would the Rockefellers do? Because I was like studying legacy stuff at the time and studying like estate planning. And there was this woman that was part of the family office for the Rockefellers. I was doing some webinars around the topic, and she's like, that's exactly how they set this up. And we started talking, and I was like, you know what? I should write What Would the Rockefellers Do? Which then took a lot longer for the book to be written. And at first we just printed 7,500 copies or something, hardcover copies. Mike would speak on stage, hand the book out. I'd use the book to book him stages. And, that worked for a couple of years. And then Wealth Factory didn't really love that system. It kind of created a little bit of like, what are you doing on the side and why not? And then Mike was working with someone else. So we kind of, at that point, Wealth Factory started to really promote the book as like a way to generate leads for Wealth Factory.
Yeah.
And it kind of took off.
Yeah.
And then they put it up for sale on Amazon for less than $10. And then advisors started just buying the book and handing it to clients because there was no like, hey, here's my website or here's a call. It was just like, And so it started to create this life of its own because it's starting to educate the industry.
Yep.
And I think the container of the fact that the Rockefellers had like 6 generations of wealth passing on, and they were using life insurance as a way to replenish their trust, was like so instrumental. And then I put legacy. So like the book went from being 100% about life insurance to being like 60% about life insurance and 40% about all these legacy
which
factors.
Made it all interesting because it brought it together. It wasn't just a life insurance pitch. It was like, hey, why you compared the Rockefeller family versus the Vanderbilt family, and the whole concept of estate planning, and the whole concept of life insurance, the whole concept of like multiple generational planning. And you talked about life insurance in a way where it's not just the benefits, pros and cons, but it was like, this is how a family actually utilized it. And it was interesting, and it's hard to argue with. And I think the reason why advisors, utilize it is the book is well written, and it's a great story. Even if someone doesn't read it, it's like, it's a great cover. It's like, what would the Rockefellers do? Like it's a legendary, man.
It's like, as soon as the title came to me, I was like, this is going to be a lot more work. But the good news is Stephen Dean, one of the writers at Wealth Factory, had been researching stuff about the Rockefellers. And so he started handing me that research because he's a good researcher. And Tom, the lead writer there, was like, oh, I know some stuff. So like they were gathering information for me. And Sheila, the CPA that worked within the Rockefeller family, like I just had this great access. And then some of the attorneys that I've worked with over the years knew about the Rockefeller methods and the Rockefeller plans and the estate planning structures because of the, Andrew, who I talk about in the book several times as an attorney. His grandfather was a prominent attorney around the people that worked directly with the Rockefeller family with their estate plans. So it's like I had some pretty nice, easy access to information that specifically about this one strategy that they were utilizing that anyone could do, even if you don't have Rockefeller money. Like I started when I was 19 years old. And that's what's, I think, really cool about that book is even though it's pretty tactical, it's not over anyone's head. It's not like, oh, you have to be wealthy. And that's the subtitle. How to get, how the rich get wealthy and how you can too, or whatever I should know the subtitle.
Subtitles.
Yeah.
As we wrap this up, any final words around cash flow banking, the end asset life insurance? It's, you said you started when you were 19, but if someone's watching this and they're like, they're on the fence, or they're any questions, is there any questions that they should be asking themselves, trying to figure out if this asset would serve them or not?
I just did my 28th policy. That one's on my wife. So 27 whole life policies now. I think there might be like 26, one term, and one indexed universal life, which interestingly enough, that's because it's premium finance.
I think it's great. I think we'll be able to see 10 years from now how
I'm eventually gonna cash it out or roll it over. I don't plan on holding that to life
transfer
expectancy.
it or 1035 it.
Right. I think eventually the cost of insurance will become problematic.
Right.
If I want to use the cash, or I have to say that I'm never going to use the cash, and only like I feel like that's an either or, not an and.
Yep.
Right. That's how I feel about it. There's people that get really upset if I say anything but positive about IULs, but but for me, I like that there's a predictability, there's a consistency, there's an economic value to that certainty, and that I know I could tap into and utilize that. Like my wife loves having a lot of savings to feel safe.
Yep.
And I like having it in cash value. It's not a bank, which I don't feel really comfortable with banks right now, other than the government will probably bail them out, like when they gave them $5.5 trillion in 08 and 09, so that they could then build more massive buildings and, make money on the backs of taxpayers essentially, and take big bonuses. So not that insurance companies are perfect or that there's not issues, because I don't agree with every bond that they hold, or
totally.
Like but I like the container. I like the private contract. I like the benefits that come with it. I like how I could utilize it along the way. And it's fine for people that hate it. I address that in chapter 2 of that book. I'm like, but Dave Ramsey hates it. I'm like, yeah, but you got to understand his mindset is all about reducing expenses. And he can only see this as an expense, not as a benefit. Because I've heard people call him and be like, well, what if you just put more in it and it goes straight to the cash flow? He's like, why would you ever do that?
Yep.
It's like, well, if I could put $1 in something and they give me back $1.05, and I don't have to pay tax on that. Yeah. 05, like why? Yeah, I would want to do more of that.
And you
why
could then
wouldn't you
recycle that dollar to do other things? Yeah.
So I look at it as very useful, very practical, very predictable.
Yep.
Nothing too sexy.
No.
But you know what? It makes my wife likes knowing that we have it. And
You're not going to have any crazy war stories that you'll be able to tell about the amazing nature of your life insurance, but the stories will come with how you use it. And I think the how is what will make or break you. The how will be like it could be the difference between you losing money or you making a ton of money, because it just comes back to the and nature of it. So I'll just plug this before we wrap up this video. If you want to learn more just about life insurance in general, we have this thing called the And Asset Vault. And we actually have some of Garrett's content in there. We have a 6-part video series, our 61-page handbook, and much, much more. If you want to learn about life insurance, would it be right for you, how we design the different type of policies, you can go check that out. Any final thoughts or words?
No, man.
From the what would Jesus do in this scenario? Like when it can get it.
Well, yeah, he would definitely take care of his people.
That's right.
Right? Like I was watching Breaking Bad and I thought that whole show happened because Walt didn't have life insurance.
It's so fascinating.
Think about it. If he has life insurance, he has cancer and he's like, I'm not going to leave my family desolate. But because of that, he ends up resorting to the most extreme situation that ruins his family's life. It's all hypothetical because it's just a written show, but my mind went there watching it.
I don't want to be blasphemous at all, so take this with a grain of salt, but I remember talking to one of my good friends, and he was legitimately like serious. He's like, Caleb, if Jesus was alive during today, he would be in life insurance. Like, he was like so fired up, and he had all these reasons. And I looked at him, I'm like, okay, I think that might be a stretch. I think there could be more important things in selling life
Probably
insurance.
Still be giving a message.
Right. I think, but the point was like, this is like, besides, the gospel, life insurance is that 1-2 punch. And again, even for where I'm in, I think that's a little bit extreme, but I appreciate the passion behind that.
Well, thanks for spreading the word, man.
Yeah.